when you talk about it being overbought and all the rest of it, really what you're looking at is trading it. You're looking at, is this too high? Should you sell it? So you buy it back later. It's all that sort of stuff. That's the wrong way to look at it, Kai. I mean, basically what we're seeing is we are seeing the establishment panicking. And by the establishment, I mean, particularly, this is noticeable on COMEX. What they did over sort of second half of January, first half of February, was they tried to cover their positions. And so we had a situation where open interest on COMEX fell by something like 75,000 contracts, while the price rose over $200. Now that is a bear squeeze by any definition. And when you get a bear squeeze like that, what happens is that the paper market starts leading the spot price by the nose. And of course it creates an arbitrage because you're looking at significant premiums over spot. I mean, normally you would get a small premium over spot, which would reflect something akin to the lease rate of gold. This time, this went up to 10, 12, and more percent than silver, I think, even higher. And really what this is, if you like, the establishment realizing that on COMEX, they are short, and this is dangerous. And if you look at the total short position, I mean, we were approaching something like $80 billion in the swaps category. Now, that is pretty serious. That is extremely serious. So what do? You're the treasurer in the bank, because all the bullion bank dealers, they're all part of larger banks. The treasurer comes along and says, look, what are you doing here? This is a position which is just getting out of control. Tell me, what are you doing? Do you see what I mean? So there's pressure on these guys to close off their positions. So you end up with a premium. And the premium, of course, gets stuff flowing from other centres. I mean, by stuff, I mean bullion from other centres into the COMEX warehouses. And that's exactly what we've been seeing. I think, all you need do is have a look at the charts, and you can see that gold is sort of pretty much in runaway mode. Now, it's quite natural in human terms to think, oh, hold on, it's gone up to, and it's getting close to $3,000, and surely that's a big number hurdle, and it's got to maybe consolidate a bit before it goes through there and all the rest of it. Yeah, it's all true. But actually, if you look if you look at it in the context of money, because gold is money and the rest is credit, as we've discussed before, then actually what you're looking at is the deteriorating value of credit in terms of purchasing power for goods and services. And we're now beginning to see what they call inflation, rising prices, which actually is debasement of currency, falling values for credit. We're beginning to see that again. The numbers are sort of coming in higher and higher. And of course, these are all government figures, so they're completely unrelated to reality. I mean, the reality is that the cost of living is rising far faster than the government will admit. Any government will admit. So, where does this leave markets? Well, they're looking at this, and increasingly people following the lead of the central banks are realizing that the risk is not in gold, but it's actually in credit. So if you want to trade this as an investor, then my goodness, you take your life in your own hands, because actually you're looking at this through the wrong end of the telescope. You may get it right, you may be clever, but for the vast majority of people, the answer is to just keep stacking. Just because what you're doing is you're getting out of credit. That, I think, is my answer to the whole situation. I think it's unlikely that gold would be included in tariffs, because it's a class 1 asset. The banking system would turn around and say, look, no way. It's as simple as that. Not only that, but most of these stories came from Trump's team before they assumed office. And it's all very well, someone like Besant, who's a hedge fund trader, saying, I'm bullish of gold and all the rest of it. And when I become Treasury Secretary, I'm going to do this, do that, and all the rest of it. But as soon as he gets into those gilded portals of the US Treasury, the permanent officials will take him to one side and say, look, this is the reality of the situation. The reality of the situation is we do not want to undermine the credibility of the dollar. Don't talk about gold. It's off limits. Quite simple. And when it comes to and this explains how he's sort of turned around. Of course, I mean this always happens, this business of a 50 or 100 year gold convertible bond, forget it. That's not going to happen either, because what are you dealing with? You're dealing with dollars that need protecting in gold. I mean, this is not the Treasury's narrative. They want to keep gold out of the whole system completely. Because gold is still the rival, and it looks like it's not only the rival, but it's beating the dollar down into the ground. I mean, from the Treasury's point of view, you do not want to talk about gold. No, Jose, forget it. And when it comes to auditing the Fed, all the rest of it, they will sit on that as hard as they can, and they know how to do it. I think that whole exercise will come away with, people like Musk and Ron Paul and all the rest of it frustrated, and the word being spread by the Treasury that all this is conspiracy theory. He's been told what to say is a short answer. And, it's not a proper audit. I mean, if you have a proper metals audit, every bar is checked for its presence, it's tracked serial numbers and all the rest of it, checked against records, the whole thing. What they have, as I understand it, in Fort Knox and elsewhere, is they've got sealed chambers. Basically, if the seal hasn't been tampered with, then everything there is all right. That's the audit. Now, you can believe what you want. Look, the fact of the matter is that, we'll switch to the New York Fed for a moment. The New York Fed stores earmarked gold for foreign central banks. Germany wanted 300 tons back. I think originally 600. That was negotiated down to 300. 7 years, they said it would take to get it back. Now, and not only that, but I understand that the Bundesbank's records, the bar numbers and all the rest of it, didn't tally with what was eventually returned. So it's quite clear that there's some very, very, skullduggery going on there. Now, the other thing, as far as the US Treasury is concerned, they have been suppressing the gold price by propaganda and also market dealers through the Exchange Stabilization Fund and so on and so forth for the last 50 years. Now, a lot of the gold which has gone out in lease would have gone out from US Treasury coffers. So, that's all you need to know. I mean, a lot of the gold simply is not there. How much? We don't know. But I mean, the point is that, you're not going to get a proper audit. They're going to sit on this story. They don't want to tell us what they've actually got, because certainly there is, a huge, great gaps, if you like, in the whole of the Treasury story. They're going to try and sit on it. No, it's the whole thing is a nonsense. The first thing to understand is that the relationship between gold and the dollar is that the dollar's value was determined in a weight of gold. The reason we say that they're currently 42, the exchange rate is $42.22, is for convenience sake. It's far easier than saying it's X fractions of a gram or grains or whatever. But the reality is that under a gold standard, a dollar buys you a certain weight of gold. That's the whole point. Now, if you're going to revalue it, then this is just going to draw attention to something which is very much in the past, has no relevance to today, and basically draws attention to the debasement of the currency. I cannot see that there is any intention for the dollar to get back onto a gold standard. I mean, that would be the point of doing it. If you're going back on a gold standard, then we will revalue it, and we will say that a dollar, or we might consolidate the dollars into, let's say, $1, $1,000 becomes one, and $1 buys, let us say, 0.25 of a gram of gold, or whatever the relationship is. One day something like that might happen, but it will be the last resort as far as the Fed is the Fed's dollar and the US Treasury are concerned. They do not want to talk about gold. That subject is dead. Forget it. I mean, it's not going to happen. I mean, eventually the whole credit system will fall apart. The bubble will burst. And then we're in a completely new territory. We're probably in a completely new political system. I mean, I really don't know. But all we know for now is where the risk is. And the risk is in credit. Get out of credit. How do you get out of credit? You get into something real, tangible, not an ETF, but physical.